Welcome to this week's episode of Financially Speaking. As a local family-built firm, Buska Retirement Solutions, along with its affiliate companies Buska Wealth Management and Legacy Tax Solutions, offer one-stop retirement, tax, and legacy planning services to families nearing or already enjoying retirement. Sue Buska is president of Buska Retirement Solutions, a retirement planning company helping develop financial, Medicare, and health insurance strategies. Over a decade ago, she partnered with her son, Cole Bruner. Cole, an investment advisor representative that's held to a fiduciary duty, is president of Buska Wealth Management, a fee-based registered investment advisory firm providing financial planning and investment management for individuals and businesses. Legacy Tax Solutions offers personal and business tax planning and preparation services. Their enrolled agent, Carl Van Setters, is a military veteran with over 10 years of accounting experience and is committed to maximizing your tax credits wherever possible. Over the last several years, Sue and Cole have continued to grow their team of private wealth advisors to meet the increasing demand of retirees seeking guidance. In 2018, Ryan Connor began serving clients at their Eau Claire location. At their Wausau location, Logan Wooler became a part of the team in 2020. And in 2023, Sue's daughter Kaylee Berenson joined the firm. As a family-built firm with offices in Wausau and Eau Claire, their dedicated team of professionals have the experience to provide custom-tailored strategies to help you achieve your long-term financial goals. The next 30 minutes will be filled with retirement information presented by their team in a simple manner that you can understand. So stay tuned because Financially Speaking starts right now.
On this segment, we're going to dive into questions about financial literacy and education.
Today we're going to talk about cash, good old-fashioned money in the form of paper bills and coins.
Today, Logan and I are going to talk about when not to open a Roth IRA.
And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today I'm joined by Cole and Logan from Buska Wealth Management and Buska Retirement Solutions. We're going to be answering some of your questions about planning for retirement, but if you'd like to see a question answered on a future segment, please feel free to email us at info@retirewithbuska.com. Cole, Logan, thank you so much for joining me today.
Of course.
Today on this segment, we're going to dive into questions about financial literacy and education. And so we're going to start with you, Cole. What are some of the basics of personal finance that everyone should know?
Well, I think in terms of what we spend the most time talking to clients about are things like budgeting. I can't tell you how many clients have come in and they've never really needed to live on a budget. They get familiar with what they've got coming in income and they know what they can spend from month to month. And often they monitor it to make sure that they're not going, crazy with expenses or anything like that. But oftentimes they've never really sat down to figure out how much every month goes to this and that and so on and so forth and kind of charting it all out. So I think having a budget is really helpful because it may also help you to identify areas that either you could maybe save a little bit of money. I know we've all got subscriptions that we don't use nowadays.
What? No.
I looked at my list the other day and I'm like, whoa, I can get rid of half of those because I haven't touched them in months, So, just being cognizant of what you are spending your money on and where it's going may present opportunities for additional retirement savings, which obviously is really, really beneficial from our standpoint. Anytime you can put a little bit more money away for your future is not only going to help you in terms of having more money, but it's also going to help with, compounding growth and all of those types of things, which are all beneficial for your future. So I think starting with a basic budget would be really, really important. Also being mindful of your debt. Obviously interest rates are really high nowadays, and especially credit card interest rates are kind of atrociously high as of right now. And unfortunately, all too often people don't pay attention to that. They're like, well, I'll just throw it on a credit card. And if you're not able to pay that balance off from month to month, that can really snowball quickly. So you really want to be mindful of making sure that you're not overextending yourself in terms of debt or anything along those lines. And I would say in terms of basic finance, those would be some of the primary things. And then also, obviously, as you start to accumulate any sort of assets, wealth, whatever you want to call it, partnering with someone that's going to be able to represent your best interest, help be your advocate in that financial planning component. I think that's really valuable too, because it again takes some of that pressure off of you to feel like you have to be an expert in everything. You partner with professionals in your life that are going to be able to add value and help you to accomplish goals that maybe you wouldn't have been able to accomplish as easily on your own.
All right. Well, Logan, speaking of financial professionals and working with them, can you talk a little bit about how our audience can improve their financial literacy?
Of course. I would start out with saying that go to that financial services professional, because a lot of the times we rely on our family or friends for that information. And we've seen time and time again that we either have outdated information that hasn't been updated, whether it's a new law or policy change, or strategies are different for every person. So what they recommend for their strategy may not work for you. So I would say, first of all, be cautious about who you're getting the information from and go to the correct type of source. But then you can go out there and there's so many different useful tools out there. If you go out to our website, retirewithbuska.com, there's a whole education portal out there, whether it's news articles, videos, watching our TV shows here. There's just a lot of resources out there to really improve your financial literacy there.
Yeah, absolutely. And one of the things that we always tell our clients is, and this doesn't necessarily directly relate, but I think it can be applicable, is one of the best things that you can do as a person that's gone through, maybe some difficulties or mistakes in terms of your financial planning, share that information with the younger people in your life. I can't tell you how many times clients have come in and they're like, man, I wish I would have known this 20 years ago. And it's like, well, your kids are 20 years old, younger than you are right now, let's say. Maybe it's a good opportunity to present that information to them, or grandparents sharing with their grandkids, or whatever it might be. Sharing knowledge of what you wish you would have known before can be tremendously valuable in setting them up for success for their future.
Absolutely. And there's a lot of myths out there, right? So Cole, speaking of sharing knowledge, can you go through what are some of those common financial myths that we should avoid?
Well, there's a lot of them out there, obviously. A lot of times we hear people asking, how much money does a person need to retire? And there's been 100,000 different numbers thrown out there over the years, and everybody needs $1 million to retire, or 2 million, or 5 million, or whatever arbitrary number they're using nowadays. And so many people come in and they ask, how much do I need to have? And it's like, well, it's a little bit more of a loaded question than that. Obviously, we have to do a bunch of research and analysis on what resources they have for retirement. Do they have a pension? What are they going to have in Social Security benefits? How much do they need to spend to live their lifestyle, I think, is an incredibly important part, because everybody's is different. What this client spends from month to month compared to what the next client spends might be completely different. So the amount of money that they need to have in their portfolio are going to be vastly different from person to person. So I think that that's a big myth that people often, kind of misconstrue. There's a whole bunch of other ones. One thing that we've seen really in our office over the last couple of years is people coming in not retiring early because they think health insurance is unbelievably expensive. Now, granted, for certain people, it can be, depending on their needs, their circumstances, their income level, all those different things impact it. But a lot of times they've just never looked at it. They have no idea. They're just making this arbitrary assumption that, it's too expensive, so I can't afford to retire. So I think those are some of the most common myths that we see, and certainly I could go on and on for hours and hours about all of the other ones, but I think that those are two of the most prominent. But being aware that there are a lot of those myths out there. So again, partnering with somebody that's going to get to know your personal situation and understands the world of finance, that can then provide you with recommendations and guidance through that process, I think is probably the best way to avoid falling victim to any of those myths.
Yeah, and I would just say one that came to mind as you were talking there is as it relates to putting money into your 401ks. Our whole life, we've always told that we'll be in a higher tax bracket while we're working because we have more income. And then when we get into retirement, we'll have lower income. So let's deal with the taxes later on, which can be true, but there's a lot more different strategies out there for that. because we know our taxes aren't going to go down anytime soon. They're actually scheduled to go up in 2026. And with our huge national debt we have that keeps growing, we could see taxes go up in the future. And then you also think about what are your income streams in retirement. If you have a pension, which are a little bit more rare nowadays, but they're still out there, that you're getting paid during retirement can count as income. Or when we're taking money out of our nest egg to pay for things, depending on what tax type it is, could also count as income. So we really want to monitor that myth of just put all your money in pre-tax because you'll be a lower tax bracket in the future. Could be true, could not be true. So sit down with that professional.
Absolutely, yeah. I can't believe I didn't think of that one. Yes. That is one we talk about all the time. But you're right. I mean, you never know what the future landscape of taxes are going to look like. And in terms of, kind of kicking the can to pay the taxes down the road, we're really kicking that can down to a big question mark because we have no idea. We might have some assumptions on what might happen through tax legislation based on, the incoming administration and all of those types of things. But at the same time, nobody knows for sure what that landscape is going to look like 4 years from now, 10 years from now, 15 years from now into the future, when we might be taking money out of those accounts and now paying more in taxes than we potentially could have if we were a little bit more proactive up front.
Yes.
So there's a lot to take into consideration. We talk about financial literacy. We've talked about saving and budgeting and debt and taxes.
Right.
So Logan, what are some of the resources available out there that our audience can use to learn more?
Yes, as we say it time and time again, talk to those professionals first and foremost there, but then also going out to the different websites that are available. As I mentioned earlier, our website has a great menu of different educational topics. Also look into what your work provides. In those different 401k, the record keepers out there are going to have some similar things too. So it's really just seeing what resources are right at your fingertips there and continuing to have discussions about it.
Watch out for those myths.
That's right, absolutely. Well, and never stop learning either. We never get to a point in time in our life where we don't have to learn more about these topics or these evolving topics because things change all the time in the financial industry. It's part of the reason why we have to do continuing education and all of these things because we have to be up to speed on all of those adjustments that may impact our clients. And so I think just never close yourself off to the opportunity to learn something new, to have a conversation with a professional that might help shed some light on something that you might not have been familiar with before.
Well, thank you both for helping me learn something new today and spending some time with me. And thank you all for watching today. We'll be back with more right after this.
Taxes can play a significant role in retirement. After all, they determine how much of your hard-earned savings you get to keep and how much you send to the IRS. But if you're like many savers, you probably don't know the total taxes that you could end up paying. At Buska Retirement Solutions, we believe information is critical to making informed decisions. So I want to share with you a resource that can help quickly evaluate your potential taxes in retirement. Visit BuskaRetirementTaxBill.com to generate your personalized report. And once you've seen your retirement tax bill, let's talk, because there may be ways to improve those numbers.
And now, our Financially Speaking weekly topic segment.
Welcome back to Financially Speaking. I'm Logan Waller from Buska Retirement Solutions and Buska Wealth Management. Today we're going to talk about cash, good old-fashioned money in the form of paper bills and coins. Given that we're increasingly becoming a cashless society, the question of how much cash should we keep on hand is difficult to answer. A U.S. News and World Report article titled, "How Much Cash Should I Keep on Hand?" has some insights that may help you determine how much money you should keep in your home, in your pocket, and when running your errands or shopping. Despite of all the new ways to pay, cash still matters. Let's first examine when and why you may want to carry cash. Though it's pretty common for folks to leave the house or office without so much as a few bucks in their pocket, that may not be the best strategy. For example, some small businesses offer discounts to those paying in cash because they don't have to pay a processing fee to a credit card company for those transactions. Secondly, technology isn't perfect. You also never know when a business may suffer a technical issue that prevents you from using a card. You wouldn't want to coast into a gas station on your final fumes with just your credit card only to find out it's going to be a cash only until the credit card machine is fixed. While the article explains that there isn't consensus about whether you should carry cash day to day, there is consensus that you should carry some local currency when traveling. The article recommends carrying enough cash to see you through 24 hours while you're traveling. That said, it's important to be careful. Cash is susceptible to theft, which means you should be thoughtful about how much you carry. What crook wouldn't want to get their hands on that roll of 20s you keep in your pocket? On the other hand, if you lose your debit card or credit card, or one is stolen, you may also be able to have fraudulent charges refunded. To combat theft or loss, the article recommends splitting your cash up. Put some in your front pocket and the rest in your chest pocket or purse. That way, if you lose some of it, you may not lose it all. The article also specifically addresses how much cash you may want to keep in your home. While some folks keep cash tucked away in their home in case of an emergency, the article notes that realistically, there aren't many emergencies that would prevent you from getting to an ATM. Natural disasters are an example of the rare occasion when getting to the bank or to an ATM may be difficult. Accordingly, a few $100 stored safely in your home is likely enough to see you through most things. That's what the article explains. Just like you shouldn't keep all your cash in one pocket when you're out and about, you shouldn't store cash in one place in your home. Keep some in the cupboard in the basement and keep some tucked away under the kitchen sink. The point is simply make it less likely a thief may be able to access all your cash. Finally, as for how much cash you should keep in your home, the article suggests that a maximum of a couple of $1,000s is likely enough for most people. Remember, the FDIC insures as much as $250,000 of the money you have in one of its member institutions. But there's no such protection for the cash in your sock drawer. Before I sign off, I want to talk about a method that has been successful for some individuals: cash stuffing. According to Bankrate, cash stuffing is exactly what it sounds like: stuffing cash into envelopes and prioritizing using cash over credit cards. You can accomplish cash stuffing in 5 steps. Make a budget, label the envelopes with your spending categories, stuff the envelopes, and only spend the money that is in the envelopes. The final step is do it all again. The benefits of cash stuffing are that it can make you more aware of how much you're spending, keep you from accumulating debt, and help you make less stress about money. Lack of security is a drawback to cash stuffing. Someone could walk off with your envelopes. Also, when you do everything in cash, you miss out on earning interest like you would in a bank account or earning rewards like some credit cards offer. It could be a good method for younger people just learning how to budget. So if you've got kids or grandkids who might benefit from this discipline of cash stuffing, you may want to share the idea with them. That's it for this segment. If you want to talk about your financial strategy and the role of cash within it, contact our office at retirewithbuska.com or call 715-355-4445. We'll be right back with more Financially Speaking after this.
Are you ready to make your retirement planning more stress-free? I'm Cole Bruner from Buska Retirement Solutions, Buska Wealth Management, and Legacy Tax Solutions. Between our 3 companies, there's a lot we can do to make securing your future easier. By creating a comprehensive retirement plan that incorporates retirement income solutions, investment management, estate planning, tax strategies, as well as health insurance and Medicare planning, you can retire with more confidence and peace of mind. Call us today or go online to schedule your complimentary review.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Ryan Connor from Buska Retirement Solutions and Buska Wealth Management. Joining me today is Logan Wohler. Today, Logan and I are going to talk about when not to open a Roth IRA.
That's right. An Investopedia article titled "When Not to Open a Roth IRA" explains when and why you may want to choose a different option such as a traditional IRA.
Choosing your retirement account will often depend on how much you're currently earning and how much income you expect to have once you leave the workforce.
So, let's talk about the differences between Roth IRAs and traditional IRAs.
Well, first of all, IRA stands for Individual Retirement Account. Both Roth IRAs and traditional IRAs help you save for retirement, and they both offer tax advantages, but those advantages are different.
That's right. A traditional IRA lets you put away pre-tax dollars. You pay taxes on those funds when you withdraw them to pay for your retirement. At that point, you'll pay a tax on your original investments as well as the money those investments earned.
Meanwhile, a Roth IRA is an account that you fund with money that has already been taxed. The benefit of the Roth IRA is that when you take the money out, you don't have to pay taxes on it.
Does that mean you don't pay taxes on the earnings either?
That is correct. You can also withdraw money from a Roth IRA before you retire.
You can withdraw your contributions, but not the earnings.
You've got it.
So, how do you decide between a Roth IRA or a traditional IRA?
So you'll have to estimate whether your income tax rate will be higher or lower than it is now when you start withdrawing the funds.
So, what about younger workers? What type of account should they use?
First, let's address the fact that many people get what their employers give them. If your employer offers you a 401k, by all means, fund it. But if your employer offers you both a 401k and a Roth, you can choose to fund one or both. And the Roth may be a good option if you're just starting out in your career.
Why is that, Ryan?
So younger people have time on their side. When you're young and you have a lot of time for your funds to grow and compound, owing zero taxes on that money when you take it out is a cherry on the sundae.
That makes sense to me. But what about a traditional IRA? What's the upside there?
With a traditional IRA or 401k, you can make the same monthly contributions to your account using less of your income. Because the contribution to your traditional IRA is tax deductible, you aren't paying taxes up front and it costs you less to make that contribution right now.
All right, so what about basic investment accounts? How do Roth IRAs compare to those?
So a basic non-retirement account, is that what you're talking about?
That's exactly right.
Well, the thing with non-retirement accounts is that you fund them with money that you've already paid taxes on. And you pay taxes on the funds when you withdraw them later.
So you get it coming and going.
That's right. Plus, when you take the funds out of a non-retirement account, you pay taxes at the capital gains tax rate.
Wait, does that mean your 401k gains are not taxed at the capital gains rate?
So let's take a quick look at another Investopedia article titled Capital Gains Tax, what it is, how it works, and current rates. It has a list of ways to avoid capital gains taxes and says that while 401ks and IRAs offer less liquidity, they may make it easier for you to buy and sell securities without incurring taxes on those gains.
Makes sense to me.
So you may end up paying more in the long run with a non-retirement account than you do with a tax-advantaged retirement account.
All right, so let's talk about when someone should avoid opening a Roth IRA.
So if you're in your peak earnings years, you're likely in a higher tax bracket. When you retire, your tax rate may be lower. A traditional account may help delay paying taxes on those funds until you are in a lower bracket.
What is the maximum amount you can earn and still contribute to a Roth? What if you earn more than that maximum amount?
So for 2025, if you earn more than $165,000 a year, you cannot contribute to a Roth. For married couples who file jointly, that maximum amount is $246,000.
Is there a level at which your contributions may be reduced?
Yes. If your income hits $150,000, your Roth contributions may be reduced. For married couples filing jointly, your reductions start to your contributions at $236,000.
So, to recap, if you make $150,000, you can't contribute as much. And once you hit $165,000, you can't contribute to a Roth IRA at all.
Exactly.
So, what about the saver's credit?
Well, with a 401k or traditional IRA, you can reduce your adjusted gross income or AGI. With a lower AGI, you can maximize the amount you get from the saver's tax credit.
What is the saver's tax credit?
So taxpayers who contribute to employer-sponsored traditional or Roth IRAs may be eligible for the saver's credit. It's a bit complicated to get into the specifics with the time we have left, but we should go over it in a future episode.
That's a great idea, Ryan.
But even without getting too far into the weeds of the saver's credit, we can say that it is designed to help lower income people save for retirement. The lower your AGI, the more you get credited back.
So you can lower your AGI by increasing your pre-tax contributions to your retirement account?
That's correct.
So, Ryan, is a Roth IRA worth it?
Well, as we said before, funding a Roth can be more expensive in the short term because you're using after-tax dollars. Sometimes the amount you save by contributing to a traditional IRA or 401k means you can buy a house or fund an emergency savings account.
It sounds like it can be difficult to decide whether a Roth is right for you, and maybe it would be a good idea to talk to a financial services professional.
That is absolutely right, Logan. We spend a lot of time helping people figure out how to best use retirement accounts to their advantage.
It's so important, I think, when people know how to leverage these accounts, they can truly set themselves up for success in retirement. But what about people who contribute to both types of accounts? Some people do that, don't they?
Oh, absolutely. And it can be hard to know what your tax situation is going to be in the future. Contributing to both types of accounts allows you to hedge your bets a little bit.
So if your employer matches your 401k contributions but not your Roth contributions, can you split your contributions so you get the match and also funds into Roth so that you'll be able to make some tax-free withdrawals later on?
You sure can.
If that strategy makes sense for your situation, you could get the best of both worlds.
The strategy can also be helpful in retirement because when you retire, there are some years when your taxes are high and some years when they were lower. A quote from the article explains it really well. Why don't you read it, Logan?
All right. James B. Twinning, a CFP and founder of Financial Plan in Bellingham, Washington, says, in retirement, there may be some low tax years due to large long-term care expenses or other factors. Withdrawals can be taken from the traditional IRA in those years at a very low or even a 0% tax bracket. There may also be some high tax years due to large capital gains or other issues. In those years, the distributions can come from the Roth IRA to prevent bracket spiking, which can occur with large traditional IRA withdrawals if the total taxable income causes the investor to enter a higher graduated tax bracket.
That is a great quote. It illustrates how people who contribute to both types of accounts could be in a good position in retirement because they will have options.
It's good to have options, I think.
I agree. And with that, Logan, we are out of time.
I think you're right. Viewers, if you have questions about opening a Roth IRA, contact our office today at retirewithbuska.com or call 715-355-4445. We'll be right back with more Financially Speaking after this.
Are you ready to take control of your retirement? If you're 59 and a half or have recently changed jobs, it may be time to consider a 401k rollover. With a rollover, you can consolidate your old retirement accounts into a single investment vehicle. Say goodbye to scattered funds and hello to more diversified options. A rollover gives you the freedom to choose from a wider range of options tailored to your unique financial goals. Don't let your retirement savings gather dust. Reach out to speak to one of our advisors today to explore the benefits of a 401k rollover.
Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us today, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. This is the same way we communicate to our clients when we meet with them in person. Remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help. Right now may be a great time to get a second opinion on your retirement plan. Call us at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on previous episodes of our TV and radio show, or schedule your complimentary, no obligation consultation.
If you have any questions or comments about today's show, call us at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time and same place for another episode of Financially Speaking.